Thank you. Good evening. I thought I'd actually start by talking about some independent academic research. We came across this a couple of years ago. We believe passionately that for long-term investors, the best thing you can do is try to learn from those who are smarter than you are. And in particular, we've looked at the research of a gentleman who's based in Arizona State University. The risk factors are available outside to reiterate the first speaker's thing. Professor Bessenbinder has looked at long-run stock market returns for the US. He's taken a pretty comprehensive data set from 1926 all the way through to 2016, every single stock in the US market. And that equates to about just under 26,000 firms. And if you invested in the markets, you made something in the region of 35 trillion US dollars in aggregate over giving your money to the US government. The difficulty being that actually only 90 of those firms accounted for half of that return. So the best 90 gave you $17.4 trillion over and above giving your money to the US government. The next, roughly 1,000 firms, accounted for the whole of that excess return from investing in the US stock market. The other 24,240 in aggregate were no better than giving your money to the US government. And we've spent a lot of time with Professor Bessenbinder saying, well, what does this mean for how you should think about investing in equity markets? Seems that some of the assumptions that our industry is based on, the models, seem to break down in the sense of looking at this data set just simply doesn't support some of the contentions. Now, some of you may have heard me speak about this research before, but we're still looking at it because we have been sponsoring Professor Bessenbinder, and this research will be made public, to do the same work in international capital markets. Say, is this something that is unique to the US market? And the initial findings, though they're not public yet, is no. The same pattern, that it's just a few companies that, if you're prepared to be patient in the long run, really drive equity market returns, investing in companies in the stock markets, is mirrored throughout international markets. Now, the difficulty is that unless you know how to pick that very small handful of companies, then surely you're better off simply replicating the market return as cheaply as you possibly can by a tracker fund, and Vanguard is one of Baillie Gifford's long-standing and largest clients, and that is one valid approach. There's lots of different ways to invest. However, interestingly enough, also spending time with Professor Bessenbinder, we've been looking at, are there common characteristics of that handful of companies that are really doing something different? And the short answer is yes. And they're probably not that surprising. You need a company that is addressing a sufficiently large market that it can keep growing material in size, not just a little bit each year, but keep getting much, much larger over time, so you can sustain that growth rate, because eventually, if you have a company that's much bigger than it was 5 years ago, then that's a pretty good place to start looking for returns. That those companies can't be run to spreadsheets or short-term targets, that you need people running those companies who are prepared to embrace the uncertainty in the world, who are prepared to be flexible, who are prepared to really think deeply about the long-run allocation of capital to fundamentally growing their operating businesses. And that if you find those, and they tend to be those that are there motivated either because they are founder owners, or intergenerational family ownership, not somebody incentivized on a 3-year Wall Street-based plan in shared options, that actually that's also a good place to be looking, because that sort of long-term commitment to investing in a business that is going after a very large market where it has a competitive advantage is, again, a good place to start looking for this handful of extraordinary companies. Now, in full disclosure terms, funnily enough, that's what we try to do for Scottish Mortgage. We don't try to do anything too complicated. We simply look for the best businesses we can find anywhere in the world that have the potential to do something extraordinary, that are run by management teams that are trying to do that and allocating their capital accordingly, that have attractive cash flow characteristics, because in the real world of business, aside from share price moves, which is a separate thing and I'll come on to, in the short and medium term, actually you need a business that has attractive cash flow characteristics to keep going, whatever your share price happens to be doing in the short run over Wall Street. This is very much actual investing in the best businesses we can find anywhere around the world. We don't think there are that many. We hold a concentrated portfolio. There are around 80 names in the portfolio, but the top 30 names account for typically 80 to 90% of the assets. The top 50% of the assets is invested in, broadly speaking, the top 10 names. And that's because if you find one of these extraordinary companies, for us as fund managers offering our shareholders something very specific, there's not much point in us playing it safe and having 1% of the fund in it. Because Scottish Mortgage is not designed to be a one-stop solution for anybody. That's our risk as investment managers, not investment risk per se. So we need to run high conviction portfolio positions, if we're right, for it to make any difference to our shareholders' end portfolios. And every shareholder, we would say, should think about total returns and their end positions in their portfolios overall, regardless of whether they hold investment trusts, open-ended funds, or other investments. We also think it's critically important, and we've heard a little bit about this already, to be realistic. The companies don't try to demand perfection on 13-week cycles. Things can and will go wrong. There will be bumps in the road. We think having an honest dialogue with the companies that we invest in and saying, we're prepared to support you in long-term capital allocation, so long as we think that makes sense with what you're trying to do in your business, so long as we think that's going to help you in your competitive advantage. And we really don't care what your quarterly earnings numbers look like, because they're irrelevant when you're trying to do something extraordinary on a 5-year basis. We think there are an awful lot of very smart people who offer investments with much shorter time horizons. There are not many prepared to take a long-run approach to investing in individual businesses, and therefore there is something that we can offer that not many others do. We also think that the capital markets are changing. Well, what does that mean? It means that businesses are staying private longer, which means those like us who invested in public quoted companies, we're not getting access to them. When Facebook listed at $100 billion, it was hardly an undiscovered gem. But most people couldn't get access to it as a private company. At the same time as Facebook became a public company in 2012, we bought another company that I'm going to come on and talk to. It's a Chinese name. It subsequently listed at $168 billion. But you couldn't actually buy it. In the first day of trading, it jumped to $200 billion. Actually accessing these companies is really important, and we believe in the long-term relationships with our shareholders. Scottish Mortgage is our oldest client. It's the reason that Baillie Gifford was created. So we have put together a large trust using our scale to bring down fees. We've introduced a tiered fee scale such that the ongoing charges to the end of the financial year 2018 were 37 basis points. That included our annual management charge. We've introduced a tiered fee scale, so as the trust continues to grow, we think it's only right that our shareholders share the benefits with us, so the charges will come down, all things else equal. And the private companies that I'm going to talk to you about, we're not charging anything else for. They're in exactly the same tier structure in their fee as they are for the public equities, because we believe these companies are exactly what we look for. They simply happen to be private. I know you're going to have another speaker come on and talk to you about the benefits of an investment trust in the sense of the vehicle structure. But broadly speaking, it's particularly well suited to taking this long-term approach to investing in businesses, particularly a mixture of public and private, because we have a closed pool of investment capital. We don't need the equivalent liquidity in our holdings. What that really means is if you want to buy and sell shares, you do so on the exchange. So we don't have to liquidate or sell our positions in the portfolio. That happens distinct as compared with an open-ended vehicle, whereby if you're buying and selling your shares, the fund manager has to buy and sell positions. An investment trust doesn't have that challenge and therefore can afford to do things a little bit differently. So we started out in 1909, and Ford produced the first Model T in October 1908. Why am I mentioning that? Well, because Scottish Mortgage was originally created to invest in the formalisation of rubber production for the huge change that was coming because of Ford's production line. So you could see the increased potential for demand in rubber because more people were just going to buy cars. Remember the 1908 date. This is Fifth Avenue. 1903 on the left of your screens, 1913 on the right. In 1903, there is one internal combustion engine on Fifth Avenue. Just a decade later, and bear in mind when this is before the formalisation of the automation of Ford's production line, the first Model T rolls off in 1908 at the end, there's one horse-drawn vehicle a decade later. And the reason I'm saying this is that sometimes it really is different. There are deep structural changes taking place that impact, driven by particular companies, no pun intended, like Ford, that are changing the broader world as well as their own business models. Now, we invest in Tesla. We think 2018 was a really interesting year. It was one of the things that struck us most was how much pressure there was on this company and us as investors not to be investing in Tesla. Tesla's trying to do something extraordinary. It is trying to electrify the fleet. It is very difficult. None of the fundamentals about the business operations have changed since the days of Ford. The more efficient you can make your production line, the better. The more vehicles you can meet so your costs come down to the cost of the parts you're trying to put into it, the better in general for your business dynamic. And lastly, it just takes a lot of capital to build a large production line. And electric vehicles are very different. It's not simply a case of changing your internal combustion engine factory over to an electric vehicle factory. The engineering skills involved are completely different. It's not as simple as taking the existing production line and retooling it. It is very difficult. The critical difference last year was the first half of the year versus the second half of the year. And by the second half of the year, they had reached a critical production run where you see the cash flow dynamics changing. Brutally, what that means is you've got more cash coming in than you have going out the door, and that's a better way to run your business. And every business, as it grows up and scales, goes through that transition. We'll see how sustainable it is, but if Tesla succeeds, it will be in a fantastic position, structurally ahead of its competition by a number of years, who still have to make their investments in electric vehicle production. Tesla is sold 50% more vehicles than its nearest electric vehicle competitor last year, and it was the best-selling luxury car in the US. We think it has the potential, if it achieves its ambitions, both in electric vehicles, but also in the solar panels and static battery storage, which fit very well with electric vehicles, to really be one of those standout companies. Now, we might be wrong, and we accept that. There's huge amounts of uncertainty. There remains questions about whether they'll succeed. But we would say the other thing you could see in 2018 was the structural shift coming towards electric vehicles. Whether it's Tesla that succeeds or not, we think that structural shift on a global basis is coming because electric vehicles answer deep-seated needs that we have here in London with congestion, that China has in Beijing and its other cities with congestion, and that actually the companies at the forefront of these sort of changes tend to have long-run competitive advantages if they get in early enough, in just the same way that Ford did. So moving on to the portfolio itself. This is what the structure of our returns look like over 10 years. Every investment we've made, The best returning, and those are not typos, we've made several 1,000% return over 10 years in the best performing stocks, some of which would be Apple, Tencent, Amazon, and there have been some where we got it wrong. The difference here is that the asymmetry is what really matters. We tend to think in investment that actually it's not making mistakes. Warren Buffett's famous rule number 1, don't lose any money. Rule number 2, never forget rule number 1. But actually the asymmetry implies that what really matters is not the mistakes you make that truly cost you. It's missing out on the ones you should have been invested in that you weren't. If you weren't invested in Apple, if you weren't invested in Tencent, if you weren't invested in Amazon, your returns would look very different. And because everybody likes to use Benjamin Graham, remind you of a quote from his book, Security Analysis, that in the short run, stock markets are voting machines. But in the long run, they're weighing machines. That if you have a business that is fundamentally doing something that's very attractive, that has good cash flow characteristics, who are reinvesting in their future, run by those who are trying to do something for the long term, then that is more stable. And if they succeed in what they're doing, the market will come to recognize it, even if it's a bumpy road on the way through. Now, in every one of those 10-year fantastic returns at the top, I can promise you at various points we have looked pretty daft. I'm going to come on and talk to you about Amazon, but in the last year alone, peak to trough, Amazon fell 34%. Well, that sounds pretty bad. Why have we got that in our portfolio? Actually, over the year, it was up double digits. And Amazon has made us a phenomenal return since we invested it in 2005. And for us, we would say, this is why, if you're going to invest in companies, you have to really look at what you're investing in. For full disclosure, our portfolio does exactly the same thing. That's the last 5 years of returns on an individual year basis. We also don't try to time short-term market moves. We are long-term in our approach, and we would suggest that Scottish Mortgage is only suitable to those who share that same time horizon. There are paper copies outside that give the 10-year returns and 5 years annualized. For context, the share price rise over 5 years was 136%. The net asset value rose 125% over that period. If you'd have invested in the global equity market as represented by the FTSE All World Index, it would have gone up 65%. I just want to spend some time actually on Amazon saying here is a company that focuses on cash flow dynamics. Here is a company that reinvests in its business very heavily for the long run. And that actually that has allowed it to grow to a considerable size. But it again comes back to putting things in context. You often hear Amazon is a giant, Amazon is dominant. Well, it's true, it's 50% of e-commerce retail. But actually, its revenues to 2018 were $233 billion. Walmart's net sales were $500 billion. Its revenues grew at 31% per annum, year on year, to 233. Its earnings grew at 233%. Now, I would say this is when you need to do your analysis, you need to dig down. Amazon reinvests its cash flows very heavily. It doesn't usually let an awful lot of money drop through to the bottom line or to the earnings or what's left once you've stopped investing. And that actually you need to look at the underlying operational businesses within whatever it is you're investing, be it Amazon or anything else, to really understand where a company might go in the future. And we think Amazon has plenty of businesses. There's a piece of intellectual capital talking about some of the areas that we think are exciting out on our stand. If you are interested, please do come and ask us. But today, there's actually a number of industries that are on the cusp of huge change, driven by the very things that underpin Amazon's success. Jeff Bezos, in the year that Amazon listed and became a public company, said, I don't know where this is going to take me, but my storefront gets better without me doing anything at all to it under the improvements in Moore's law. That's the improvements in semiconductor chips. Roughly every 12 to 18 months, it doubles in what it can do. And that's a fantastic place to be investing as a business. The next areas of change are coming, and they're coming in the electric vehicles market, they're coming in healthcare. In the interest of time, I'm going to skip over Alibaba, which is the e-commerce giant in China. There are the statistics from its sales day, and move straight through to say the data behind that is driving a financial services business which is extraordinary. In 4 years, it became the largest money market fund in the world, overtaking that of JP Morgan. It offers 5 different services on its platform and then uses the data across it. There's an extraordinary opportunity, but it's a private company. We got the opportunity to invest because I mentioned we invested in Alibaba in 2012 as a private company. We've supported it throughout. When it became a public company, we didn't sell our shares. We didn't try to time the markets. We're only interested in knowing what they do over the long term. Not many people got the opportunity to invest in Ant Financial, which we think could be the best financial services company in the world today. And yet, most people can't access it. What we're saying is Scottish Mortgage offers you the opportunity to gain that access, which would not be possible to do directly. New areas of change would include healthcare through genomics. We've spoken about it before, but the changes that are coming here, combined with our ability to use the data that full human genome sequencing is giving us to improve our understanding of biology, over the coming years is going to change not just diagnostics, but treatment paradigms, proving better outcomes for some of the worst diseases that we face as a society, and will change structurally the industry around it. We think that getting access into companies early enough to capture the value created by the extraordinary growth is really important. We think that it's very difficult for many investors, even if they're aware of these companies, to even gain access today. Companies are staying private for longer. They're very choosy about who they want to invest in their businesses because they want to keep investing their capital to grow those businesses. Our reputation for doing just this, to being long and loyal shareholders in Amazon, despite what its share price might do over a 6-month, a 12-month period, or even a day, really matters to them because they want somebody who's prepared to support them in their extraordinary ambitions. And that gives us access to a wealth of private companies. It's currently just under 18% of the portfolio. If you add in those where we invested when it was private that are now public, it's nearly a quarter of the portfolio. We think going forward that access will be even more important so that you can gain access, as you can see the difference. Public market investment is in the pink square, the pale pink square. The darker squares are not accessible to you if you're only investing in public markets. We think some of these changes are coming, we don't know exactly when, but we think the long-run trends are actually easier to predict than short-run moves in stock markets that change on a variety of things, and not many people are trying to do so. So please invest in progress with Scottish Mortgage. Thank you.